There's nothing like a new car, huh? The new car smell, the warranty, the massive drop in value as soon as you drive it home. The loss of a vehicle's value over time is called depreciation, and it's one of the main downsides to buying a brand new vehicle. Luckily, insurance can help with that, at least in one very, very specific way. In this video, we're going to learn about depreciation waivers. Okay, first things first. Depreciation is what we call the reduction in an asset's value over its lifetime. Or in non-accounting jargon, the value something loses as it gets older and older. Let's say you buy a brand new car for $30,000. You pay 30 grand for it, but it will never be worth that much again. Day after day, year after year, its value goes down. That's depreciation. Vehicles depreciate quickly. On average, a new car loses 10% of its value in the first month, then 20% after 1 year, and 15% each year after that. So, what does this have to do with car insurance? Car insurance covers the cost of repairing damage to your car, but it only pays for the repairs up to the vehicle's depreciated value at the time of the accident. Depreciated value is also called actual cash value. The easiest way to think about it is what the vehicle would be worth if it were up for sale on the open market. So, if your vehicle needs repairs that will cost more than that amount, your insurance provider will write the car off instead of paying for repairs. You'll get a cash settlement based on its value minus any deductibles, and your insurer gets the damaged car. Now finally we come to the depreciation waiver. It's an optional endorsement for your car insurance. It's called OPCF 43 or 43A in Ontario or QEF 43 in Quebec. If you have this optional endorsement, your insurance provider won't deduct depreciation when they calculate claim settlements. Instead, your policy will pay whichever of the following costs is the lowest. 1. The cost of repairs. 2. The original purchase price of the vehicle. 3. The manufacturer's suggested retail price. Or 4. The cost of replacing the vehicle with a similar new vehicle. Doesn't that sound nice? But don't get too carried away. Depreciation waivers aren't available for all vehicles. Depreciation waivers are only available for new-ish vehicles. What new means depends on the insurance provider, but think between 1 and 3 years old tops. If your car is older than that, decision made! You don't need a depreciation waiver, but if you've got a new car, you may find the waiver very useful. Let's start with leased vehicles. If you lease your new car, you don't own it. The lessor owns it. If the car gets totaled, they get the payment. Without the depreciation waiver, the insurance settlement could be less than the remaining lease value, and you'd have to pay the difference back yourself. With the waiver, your policy would cover the vehicle's full replacement value, and you'd be in much better shape. If you finance your vehicle, on the other hand, you do own it, but you're responsible for paying off the vehicle loan, even if the vehicle gets destroyed. In the first year or two of ownership, your finance car's cash value can be less than what you owe on the loan. Again, you'd have to make up that difference yourself if the vehicle gets totaled, unless you have a depreciation waiver. And finally, if you buy a brand new car with a full cash payment up front, you have no one to pay out if your new car gets totaled. But a depreciation waiver would ensure that you get a full replacement value settlement if your new car is written off, which will, of course, help you replace it. Perhaps you've heard of gap insurance before. If you squint and tilt your head, gap insurance looks a lot like the depreciation waiver. But what gap insurance does is slightly different. It covers the difference between a total loss settlement and the amount you owe on a leased or financed vehicle. It fills the gap, you might say. Gap insurance is different in a couple of ways, though. First, it's usually a separate product, whereas the depreciation waiver is a part of your car insurance policy. Second, depreciation waivers are only for very new vehicles, and they last only for the first 1 to 3 years. Gap insurance, meanwhile, lasts the whole lease or finance period. And you can also get it for used vehicles if you're leasing or financing them. So which do you get? Depreciation waiver or gap insurance? Assuming your vehicle qualifies, depreciation waivers are usually the way to go. They tend to cost less, and you can very easily add them to your existing car insurance. But if you're unsure, have a chat with your insurance provider to get a car insurance quote, perhaps with a depreciation waiver. Check out squareone.ca or click the link on the screen. And make sure to subscribe for new videos. Thank you for watching, and I hope you found this helpful. If you tell me to turn one more time. Gap insurance is Darren, I'm just making you work for this one.